Today, we will understand dollar surge, global market divergence, and predicting Indian indices. Hi, guys, this is Shilpa Raidas, and welcome to Midweek with Indiacharts. And I welcome you. We have Jay Vora with us. Welcome, Jay.
Hi, how are you doing?
I'm doing very good, Jay. How are you?
All good. All good.
Wonderful. It's great to catch up with you this week. We couldn't have the midweek last week. We had some engagements, but we are glad we are back. And I would like to quickly get on to the first question with you, Jay. We have seen a spike in the dollar index and the US 10-year yields recently, right? So what's going on there and how is the US market placed?
Right. So before going to that, we had some important data points. So one was the non-farm payroll data. Over here, actually, some weird things are happening. So the data was suggesting that there was a strong job openings and all. But for last 3-4 months or so, the data has been getting revised on the downside, which means that if I'm just giving an hypothetical example, if the government shows that the data opening is 100 jobs, then it is getting revised lower on the downside. I mean,
Right.
after the revision. So that is what is happening over there. And actually, that is suggesting a weakening in the jobs data as well. So far, there has been job addition, but it is kind of weakening. And there were many other parameters like PMI and all, that seems to be indicating some sort of slowdown. But just a month back, after the Fed's language or the Fed speech, market started anticipating that the rate cut we'll get to see the rate cut as soon as March. But as the data points are coming out and it is not cooling off to the extent which is required for the Fed to cut in March. So that's where market is sort of resetting its expectation, and now most likely they are expecting a rate cut from June onwards, right? So now because of that reason, there has been a spike in the yield as well, because what had happened was that there was a lot of rate cut expectation that was building in, right? Now that is getting a reset, and that's why you saw a 10-year bouncing back from 370 or 375 or to 4 sort of levels now. Now, the other important thing is that the dollar index, and we had highlighted, last week, when we last interacted, that time we had highlighted that the 40-month average for the dollar index was somewhere around 100.75 or so, okay? Or it was 101.75. The dollar index has respected that and it has again bounced back. So until it does not break its recent low, there is a risk of dollar index also rising higher. And if that happens, that can be a near-term headwind for the markets, and especially for the equity markets in general. Okay. Now, when we look at the US indices, I'll quickly share my screen.
Okay.
So when we look at the US 10-year, okay, US 10-year and the dollar index has sort of similar patterns, where it formed a bottom. Okay, and from there, now we have seen a little bit of spike over there, but both of, the dollar index and the US 10-year, they seems to be resisting at the 40-day average. Okay, it's only when the 40-day average gets broken on the upside, that's where, furthermore up move can be possible.
Right.
And looking at the current structure, that cannot be ruled out. But like I said, the 40-day average needs to be taken out on the upside. Now, quickly, if we go to the dollar index, almost a replicate chart over here, there has been a decline and then there has been a spike and it is resisting at the 40-day exponential average. So again, over here, if this 40-day exponential average, which is around, say, 103 sort of levels, if that breaks on the upside, then there can be further more up move. Now, the fresh leg of down move in the dollar index will occur only if this low is broken, which is 100.62. Okay. Until then, there is a risk of an up move in the near term. So this is what I was talking about, that this can be, some bit of worrisome point for the equity market in the near term, at least. Okay.
Right.
Now, when we look at the US indices, it's frankly all over the place. Now, the reason why I say that is because when we look at the US indices, uh, yeah. So when we look at the US indices, over here you would see that everything is actually rising, right? But when you actually zoom out the chart, and when you understand the chart structure, that is the only time you'll get to know how the internals are, right? And internals, to me, honestly, it looks a bit weak, because many of the people are saying that the US banks are at new 52-week high, but when we look at it from an overall context, it was like, they have been falling and without any major retracement, and it's only now that it has gone up. So I believe that this area is likely to be a very strong resistance zone, okay, which is like around 500 to 510 mark. And I think until that doesn't get cleared, okay, I wouldn't be too bullish at this point of time. Okay. So what I would expect is that somewhere over here, there can be a cool off, which the US bank can see. And based on that correction, we will assess that, whether again, it's going to rise higher, or is this a top and we are going to fall. Now, the reason why I say this is because when we look at the Russell index, okay, something similar happened. Okay, market was very excited about this. Can you see this range? So
Yes.
this was the range which the small cap index had broken on the upside. Okay, but 3-4 days after, it could not sustain, and there was a quick give back of all the gains. I mean, more the entire gains that it was seen over here, especially around the breakout point, that was given up. And now what Russell is seeing, that there was a gap up over here. I mean, there was a gap over here. So this support Russell has taken, and it is now trying to bounce back. Now, if this actually low breaks on the downside, then Russell could actually be in trouble. Okay. So that is where, I mean, this is not a pretty looking chart, frankly, because once the breakout occurs, you wouldn't expect that index to, again come below the breakout point. Now, this is one. Then the other one is the Dow Jones Transportation Index. So over here as well, if you see, there has been a massive divergence. I mean, typically people who follow Dow theory, they say that US, the Dow Jones Industrial and the Dow Jones Transportation, they should go hand in hand. If that doesn't happen, then there is some trouble in the market. Okay. So actually what is happening is that the US indices had made a new 52-week high, or the all-time high. But as you can see, DJT is well above its previous high, right? And that is like a divergence among the US indices, right? And in fact, DJT has not even surpassed this high. Okay. So that is where, I mean, it is not very clean in the US indices, while when we look at the short-term charts, it seems like everything is rising. But when we zoom out, then all is not that great. In fact, even when you see the Dow Jones Utility Index, okay, it is also way below its previous high. It's actually the Nasdaq index, which has been a star performer, and the 6-7 stocks which are there, which is of high weightage, that seems to be driving the market up. And that is why, you see that the Nasdaq index is almost back towards its previous high. S&P is back towards its previous high. Okay. Dow Jones is back towards its previous high. In fact, it has broken above the previous high. So this is what I was talking about, the divergence, right? So DJT ka this high, this high of Dow Jones, the Dow Jones Transportation has not even broken this high. Okay, which means that this entire rally was, I think, mostly led by the tech sector, or the or some other sectors. So that is what we are seeing right now. I mean, the internals of the US markets are not so great, but so far in the main indices like S&P 500, Nasdaq, and the Dow Jones Industrial, we don't have a reversal, and we need to see if the recent lows are protected or no. If they are broken on the downside, then definitely we are in for some correction in the short term. And then post that, we'll see how things unfold in the days to come.
Okay, that's very interesting. Thank you for the clarity, Jay. So we are seeing diverging moves across the world market, right? And the Japanese index has hit a new high, but China and Hong Kong indices are at 52 weeks low. What's going on there, Jay?
So yeah, so let me open the emerging market. Now over here as well, I mean, while everything may look very good, like I said, for in the short term, but that is not really the case. So yeah. So yeah, over here as well, you can see the Hong Kong index. It has been continuously sliding down. If you see the
Right.
Shanghai index, that has been continuously going down. So if you see the Australian index, it seems to be rising higher, but in the overall context, it has not even broken the 2022 high. Okay, so let me zoom in. So it is basically trading in a range over here. Okay. Now, if I pick any of the Asian indices, okay, they are either weak or they are at 2022 highs. So if you take Jakarta, you see something very similar, that they are at the 2022 peak. If you see the Brazil index, it is very much similar, wherein it is trading around this 2022 high. Okay. I mean, Shanghai is gone. Hang Seng is trading at 52-week low. Kospi, recently, it made an attempt to break above the previous high, but that has failed and it has cooled off. In fact, even if you see Taiwan, it is well below the 2022 high. Okay. And most of them in the recent days are actually seeing correction. Right. So what is happening is that, there is a lot of divergence which is there in the market. In fact, the funny part is that Nikkei index has made a new high, right? And I read somewhere that it has broken the 1990 high. So we just quickly, let me check. Okay, so the peak was at say 39,000 or so. So it is not quite there, but yes, I mean, in the short term, it has definitely made one more new high, and that means that, over there at least the momentum seems to be continuing. So this is what basically I'm trying to say, that I mean, the market is all over the place. I mean, who would have imagined that, I mean, the Chinese index and all would have been, languishing at the 52-week low. Okay. And the Indian indices, Nikkei and all, they are rising higher. I mean, the US indices also relatively are performing good, but that is not the case across. Now, the point is that, see, something is wrong. Okay. The reason why I say that is because now the Asian indices which are trading at lower levels, they should either catch up, okay, or the Indian indices or the other, US indices or Japan, which are trading higher, they should correct. And the other thing, which not probably many people are taking notice of, is that Brent crude, okay, it has been continuously falling, and people normally say that a falling crude is good for Indian economy and all, but it also kind of tells you that the global market is weak. I mean, the trading, I mean, the growth in the global market seems to be slowing down, and because of that, the Brent crude is going down. Because if the economic activity is very good, ideally Brent would pick up, but on the contrary, it is falling, right? So that is another pain point. I mean, even if you see copper, if everything was so good, then why copper is not rising? That sort of tells you the health of the economy. But even there, it has been lackluster. So something really is not adding up. And the reason then I found out was that, many people are saying that the liquidity is very good in US. So I'm not too sure, how long the liquidity can support if the growth is not there. And you pick up any data point in the US indices, and it is seems to be pointing out in a slowdown sort of territory or in a declining territory, which means that I am not really sure if we are going to get a robust, quarter in US. And if the up move is not on the back of the earnings, I mean, PE cannot keep on re-rating, right? So this is where I find the disconnect. And we'll come to the Indian indices. So in that sense, Indian indices are relatively immune because over here we are seeing growth and everything. But I'm more worried about the uh, cues that we are going to get from the world market and how India will behave in that context.
Right. Okay. So thank you so much for that, Jay. That also brings us a lot of clarity. Considering all of these, what should we expect from the Indian indices, Jay? And what are the sentiment data on strike telling us right now?
Yes. So when we look at the Nifty chart, what has happened is that there was a doji last week, okay,
Right.
which sort of tells you that there is indecisiveness among the market participants. And during the week, we also broke the low of the doji. Okay, but now what we have to see is a follow through of that. And when we do go to the lower time frame and we check the daily chart. So over here, what is happening is that even the 20-day average is not breaking on the downside. So until that holds, you would have this doubt in your mind if one more new high is possible or no. Like, can it be something like this and the Nifty index makes one more new high before it declines? The reason why I say that is because so far the decline has been very lethargic. Okay, so if it has to do a bigger decline, ideally it would have picked up pace. So it is not a preferred view that it will go up and only then go down. But yes, I mean, till the time the 20-day average is not breaking on the downside. So the 20-day right now is at 21,488. So until we don't get a close below that and we don't see Nifty sustaining below that, there is a risk that one more move on the upside can play out. But overall structure doesn't seem to be that great, and the internals of the market are becoming weak. I'll come back to I'll come to that point in a while. Before that, we'll just see the other indices. So see, I mean, in Nifty index, what is happening is that there are handful of stocks which are now it has a great weightage in the Nifty index, and they seems to be saving the day for Nifty. So for example, Reliance Industry, it has made a new high, and it is sort of trying to break out from this entire range. Okay, even HDFC Bank, which was a laggard. So you can see over here. So HDFC Bank also, this has been in a range, and even that was trying to break out, but recently it saw a correction. Okay. So I mean, Reliance and HDFC, they both account to for 30% or so in the Nifty index. So if they were to break out, then surely, I mean, we may not see that big correction in the Nifty index, and in fact, we may see a lot of rotation. But frankly, what I'm worried about is the small and the mid cap index. The reason why I say that is because, see, over here, when the RSI was overbought and it was, I think, around in high 80s or so. Yeah, so it was 87 or so. Okay. Suddenly, out of nowhere, what we saw was a very sharp decline. And after that, it again started going up. Right. Now, what you see over here is something that is happening on the weekly chart. Okay. So when I switch to the weekly chart, I see that the RSI reading is very high. Okay. And we are seeing this negative divergence. And this is the mid cap index. Okay. But if you see the small cap index over here, the RSI is 87.
Okay.
So what we saw on the daily chart, a sharp decline. You can actually see a sharp decline on the weekly candle as well to get the RSI readings, which are right now at overbought. So this reading, which are in overbought zones, that will end up getting corrected if we get a very sharp decline on the weekly candle. So now that is my fear that, small and mid cap, there is a possibility of this thing happening. Okay. So for the Nifty index, what is happening is that it hasn't run that much as fast the small and the mid caps have run. Okay. So that's where, more than Nifty, I'm worried about the small and the mid cap index where the reading seems to be very high. And just in a while, I'll show you how the momentum is also weakening over there, right? If you see the bank Nifty index, that was the one which was already weak, and it had broken the 20-day average and it has corrected. Okay. Now, furthermore, correction is possible if the bank Nifty closes below the 40-day exponential average, which is the blue line. And that is right now around, say, 46,720. Okay. If that breaks, then there can be furthermore selling pressure. But one good thing that has happened in the bank Nifty is that it has completed the cycle. And this is what we were telling for a long time, that we want the cycle to complete, and then if there is a bullish crossover, we'll see how the situation is. If you see the mid cap index, if you see the Nifty index, it has not completed the cycle. If you see the mid cap index, it is nowhere near completing the cycle. If you see the small cap index, again, it is nowhere to completing the cycle. But all you see is that they are going into the sell mode. Okay. And if they are going into the sell mode, then it sort of tells you that either they are going to be sideways or there would be a lackluster movement, because that's what the momentum indicator is showing, and that is loss of momentum. Now, when we come to the strike and we see, why I am particularly slightly worried about the small and the mid cap, and in fact, all the other indices, is because when I run the percentage of stock above the 20 SMA, okay, and that too for the small cap index. So wait, let me zoom out a bit. So you can see that the small cap index is at higher levels, but you can see that the percentage of stock above the 20-day average, that seems to be going down. Okay, which means that internals of the small cap index is not looking that great particularly. In fact, from the high of 80, 83 it made, now that percentage has fallen to 64. Now, this similar is the case with the mid-cap index as well. So when we look at the mid-cap index, again, same story. It made a high, say, around 86 or so, and then it has fallen. Same is the case with the Nifty 50 index as well. In fact, over here, the reading is 56. Okay. Now, the other point which kind of worries me as well, and which we have discussed in length earlier as well, and that is the participant positioning of the FIIs and the way clients are behaving. Right. So over here also, see, what happened was that this went to the second line and it stayed above the second line for a while, and people thought that one should now ignore it. It doesn't work always like that. But eventually, what you ended up seeing was a correction over here, right? Now, something similar is happening over here, where this the FI's positioning is kind of sustaining at the higher levels. Okay, but like I showed you the internals of the world market as well, that is not great. Dollar index also, it has risen from the lower levels. Bond yield also risen at the lower levels, and the other Asian indices are weak. If you consider all that backdrop and you see the FI's positioning at the highest level, where there is a risk of a correction. So at this point, particularly, I'll be careful. And the point at which I'll be more careful is when the 20-day breaks on the downside. So which is this point. That is 21,488. Because if the 20-day breaks, then that's where, I would think that this entire move is possibly getting over. And we are likely to see the retracement in the days to come. Right. So, first was the FI's positioning. Okay. And then apart from that, it was client positioning as well, where they were too short in the index. And typically, when we see clients, short getting below that second line, okay, that's where usually the market top can occur, okay, which you see over here.
Okay.
Okay. So that's where we are right now. And so far we haven't seen a decline yet. But we need to be careful. We need to be watchful. And for everything, I think the 20-day average will sort of be the trailing level. If the 20-day breaks, that is this 21,488 mark, that's where, all the bullish bets should be off. And we need to be careful. That is because, then there will be a chance of a deeper correction to come. Now, the other thing also is that when we look at the breadth, the 40-day breadth, it has now again come back towards the second line. Okay. Normally, see over here also what had happened was that it came to the 40 line over here somewhere, then after it came over here, and then it went for a sideways period for a long time. So we don't know at this point of time if we are going to get a correction, or we are going to stay sideways for a very long time, right? But when this indicator, particularly reaches at the higher level, that's where we kind of need to be careful, and we need to see how things unfold. So like I said, all this sentiment indicators, they are throwing us some warning signs, but the main thing is that we so far don't have a confirmation from the price action, right? If there is a break below the 20-day average, then that's where I think all these things which are showing us that we are either a bit overheated or at elevated levels, then those all those all readings might eventually cool off, and that may lead to the correction in the days to come.
Okay. Wonderful. So we need to be careful, we need to be watchful, and the sentiment data on strike is certainly talking volumes with us. We need to just understand how to read it and understand it properly. You need to certainly get onto strike and start your journey with strike if you haven't, that is. Jay, we also have a good news for all the traders and investors, because Strike has now gone pro. So your comprehensive all-in-one analytics tool is now available for subscription. If you haven't gone as yet, you can check the details. We have subscription that's available from a span of 1 month to 5 years, so you can choose what suits you best. And certainly Strike has proven to be one of the nation's most advanced data and analytics tool, and will certainly continue to do so. Before we leave, I would also like to tell our viewers about the free webinar that we are holding this Sunday, which is going to, Jay Vora is our speaker, in fact. The webinar is going to tell you a unique way, you can learn a unique way of identifying medium-term trend reversal with the help of open interest using strikes. So I urge you to attend the free webinar, book your seats right away. I'm going to leave a link down on the description. It's going to be held this Sunday, that is on the 14th of January, between 10 a.m. to 12 p.m. And that's all I have for you today. Thank you so much, Jay, for the wonderful session. Take care.
Thank you.
Thank you. Bye-bye.